Okay, we are going to go ahead here, kick off this month's webinar, and just want to highlight a few of the team members. So Monica, thanks for setting all of this up, and she'll be allowing the stragglers to join after we get started here. Mike Veneria is attending as well. Looks like Sean's on the phone, but he's back from some military training last month. Shane tuning in here. And then last but certainly not least, we have welcomed Jen Fisher back to the office after her maternity leave. She's doing well, and it's great to have her back. So, all right, everyone. So thank you for joining here. Just want to make people aware Q&A is enabled. So at the end of this discussion, I'll take a look at the Q&A box and see if I can either re-clarify or answer any particular questions. So you'll be able to notice that up top there should be a little Q&A hyperlink or tab, if you will, with a thought and a question mark on it. So you hit that, type in the question, and we can take a look at that at the end of the session. So with that, we are going to go ahead here and get started as we talk about 2023 year-end tax planning. So this is a little bit different than last year. Last year, Shane and Jeff presented. They went pretty in-depth into a number of different topics on overall tax, and then specifically highlighted some nuances of Pennsylvania and New Jersey. Here, I'm going to be going a little bit more strategy specific. It's going to be a shorter webinar, but hopefully several touch points that you can kind of build out a checklist, if you will, for yourself and begin on. I think the first thing I would reference is let's put an emphasis, as we always do at Ausperity, on planning. So we're having this discussion and we're having this webinar in November and in mid-November for a reason. That these are some steps that you can utilize before the calendar year ends and potentially put to use to lower your current taxes or even put you in position to lower future taxes as well. So as we go ahead here and work through the disclosures, number one is going to be tax loss harvesting. So what is tax loss harvesting? In general, it's selling investments that have lost value in order to offset the gains from investments you sold that generated value. Okay, so if you have an investment portfolio, you're taking withdrawals for maybe retirement or cash flow purposes or a large expense. If you sold some of those investments that you've had for many years with these gains, you're subject to capital gain tax. What you can do to offset that is potentially sell some investments in the portfolio at a loss. You take your gains and your losses and you kind of neutralize them. And it's a great way of reducing capital gain taxes. Many bond investments over the last 18 months have produced negative returns. For us, what we're looking and doing is utilizing some of the bond portfolio. Not only are we rebalancing based on the new bond market environment that we're in right now, but we can sell bond mutual fund A, replace it with bond mutual fund B. If there was a loss since purchase of bond fund A, that loss is being utilized to offset gains. And it's not all investment gains of investment assets like stocks and bonds. You could have a capital gain due to the sale of a property. Your capital losses that you can realize from an investment portfolio will offset gains of an investment property or a real estate property. So something that you want to keep in mind from that standpoint. A potential strategy, and one we've been utilizing more of, and one we did a webinar on over a year ago, is the use of a custom index. This is where you build out theoretically your own S&P 500. So instead of just having the Vanguard S&P 500 ETF, you might own, say, 300 of the 500 stocks inside of the S&P 500. And the benefit there is that because you have direct ownership of all of those stocks, you have cost basis on all of those individual stocks. Let's say after 2 months since purchase, shares of Coke in your portfolio are down. This custom index and the algorithm will have you sell shares of Coke and replace it with shares of Pepsi that maybe was not owned. So you're not upsetting the apple cart. You still want to get the same performance, and the goal is to get the same performance as the market, but you now were just handed the loss. The loss of your Coke shares is being compiled to offset gains elsewhere in your portfolio. So that's a custom index and something we're doing more of for clients that have large non-retirement accounts. It's essentially a tax loss harvesting strategy meant to give you similar performance to the market, but the added benefit of tax minimization in the form of capital losses. Something to note, if you are looking at your portfolio and you are selling an investment at a loss, you must wait 30 days or more to repurchase that investment. Let's say you have restricted stock that you get from your company and it's reoccurring and it's coming in on a yearly basis and it vests at different periods. Maybe that restricted stock that came in last year or this year might be down in value. If you sell the stock but still want to own, right, representation in that company, you can buy that stock back. You just need to wait over 30 days. If you sell an investment at a loss and buy it back right away, can't do that. It's going to negate that capital loss. So then that loss becomes useless for tax purposes. So if you're going through and doing tax loss harvesting, make sure you avoid the wash sale rule. And then lastly, this is not commonly known or at least referred to, is you can utilize up to $3,000 of capital losses to offset income. So let's say the client has a $7,000 gain. They're looking at their portfolio due to some investment changes over the course of the year, and they decide to sell $11,000 worth of losses. So now that $7,000 gain has been wiped out completely, and we have a $4,000 capital loss heading into the end of the year. If the year ends with a $4,000 loss, $3,000 of the loss is going to be utilized to offset income. If that individual finished with $100,000 of income, they're now going to show $97,000 of taxable income. The $1,000 additional loss, because remember there was 4 net at the end of the year, 3 is used to offset income, 1,000 will be carried over and can be used to offset gains in future years. For someone that's in a 32% tax bracket or more, utilizing the $3,000 capital loss could be over $1,000 in tax savings. So that is tax loss harvesting. Something you want to be aware of, and this is always a good month to check. Maybe even October could be a little bit better as you look at Q4, but look at your retirement contributions. So a good step would be to log into your 401k plan or look at your IRAs if you're making IRA contributions and make sure you're taking full advantage of the potential deduction available there. So this is contributions to 401k plans, IRAs, and then HSAs or health savings accounts. In 2023, the max 401k deferral is $22,500 with a $7,500 catch-up if you're over age 50. For IRA and Roth IRA contributions, maximum $6,500 with a $1,000 catch-up. Something that you might be looking at doing, and we might be assisting with this, would be something known as the backdoor Roth IRA. Now, there's no immediate tax savings here, but what you're positioning yourself for is tax-free growth. As you know, us here at Ausperity, we love everything Roth. So moving assets and having assets in Roth IRAs or Roth 401ks will allow future growth to be tax-free so long as you've had that Roth for over 5 years and you wait until you're 59 and a half or older to take that withdrawal. So just real quick step back. The backdoor Roth, that's a contribution to an IRA. That's a non-deductible contribution. So this is after tax. There's no benefit this calendar year for making that contribution. And then it's the subsequent conversion over to a Roth IRA at a later date, positioning yourself for tax-free growth inside of that Roth. You can do IRA contributions, Roth IRA contributions, and backdoor Roth in addition to the 401k. So if you're really trying to supercharge retirement savings, you can make a full max contribution to the 401k and then also look to do IRA or Roth IRA. If you're not sure whether or not this makes sense or applicable to you, feel free to contact us and we can walk through your specific situation. And then lastly, the health savings account, which I love. It is triple tax-free. So what do we mean by that, triple tax-free? It's a deferral from income. So $33,800 for self and $7,750 for families. So that's going to come off of your income. That's going to reduce your income. So there's the salary deferral benefit. There's the tax-free growth while it's inside the HSA, and then it's a tax-free distribution so long as it's used for approved healthcare expenses. So HSA triple tax-free. However, you need to have a high deductible plan that allows you the ability to make that HSA contribution. But many people don't realize that you're getting a deduction on your HSA funding. So that will lower current year taxes, and then it also positions you for tax-free withdrawals for medical expenses. The quick tip there is if you can, pay for your current year-over-year medical expenses out of cash flow. Do not touch your HSA. Let it be invested, let it grow, let it compound tax-free, and build to a much larger asset base that you can utilize later in retirement when you likely have more and larger expenses for healthcare purposes. Another strategy to talk about are bunching your deductions. So this involves grouping together itemized deductions in a particular year where you're going to exceed the standard deduction. So the standard deduction is available to any tax filer. If you're married filing a joint tax return, it's $27,700. If you're filing a single tax return, it's $13,850. So if you don't have itemized deductions that are above those thresholds, you're taking the standard deduction. That's a gift from the IRS allowing you to deduct off of your current income. Now, I believe the numbers are 80 and approaching 90% of tax filers are no longer itemizing their deductions because the standard is so high. However, let's say that there is a large income year that you're currently experiencing, sale of a business, a big a capital gain distribution, or sale of a property, or a big payout from your company or your employer. And you might want to reduce and look for ways of reducing your income. Think about bunching your deductions. So a donor advised fund is often used where you can move a large portion of your assets into a donor advised fund. You get a full calendar year deduction on that contribution. However, you don't have to make and distribute all of those funds to charity right away. You can distribute your funds as you please over several years, and you can distribute them to several charities. So maybe you're just creating the donor advised fund, which is the hub, and that's where all future charitable contributions will be made from. However, you're getting an upfront deduction on that initial contribution to the donor advised fund. Or you're simply looking and saying, hey, maybe I'm going to do 3 years of charitable contributions this year because this is the year where it's really going to benefit me. I'm going to be able to maybe make charitable contributions or accelerate other deductions available to you now when you're going to be itemizing and might have $50,000 worth of deductions to help lower your current income. And then you just may not give to that particular charity or charities over the next couple of years. You're kind of bundling in your bunching. So you're accelerating the gift in a particular year to benefit your tax situation. Maybe future years you hold off on those charitable contributions. So you're making 1 or more years worth of charitable gifts in the year where it might benefit your tax situation the most. So again, there's some planning involved, some foresight, some thinking. Where am I now? What's my current situation? And then what do I have in my toolkit to kind of leverage to help minimize my tax situation. Deferring income is another way you can kind of look for some year-end tax planning. This is going to be particularly important if you expect to be in a lower tax bracket, or when it's deferring income into future years to receive the money in years when you're in a lower bracket. Okay, we're working now, we're in a higher tax bracket, we're going to be retiring. That's pretty common. So what are some strategies? Number one, deferred compensation plans. If you are eligible through your employer to utilize a deferred compensation plan and you're close to retirement, this might make a lot of sense. Say you defer your bonus. That bonus is $50,000. Instead of paying income tax on that $50,000, if you're in a 30-some% bracket and netting only 2/3 of that $50K, you have the ability to utilize a deferred comp program to receive that $50,000, and then you set up to have that money paid out to you after you're retired, when you might be in a 12 or 20% tax bracket. That spread of current income to future retirement income is going to be tax savings. So the deferred compensation programs can be very, very helpful if you're close to retirement, you're in a high tax bracket now, you've done your planning, when you retire, you're going to drop to a lower bracket. Think of it this way, you're receiving just more of your own money. You are splitting less with the government. The other benefit of deferred compensation programs is you can invest those funds for those years before they're paid out to you. So something to be considered if it's available at your employer. You might have missed the enrollment period this year, but keep an eye out. Usually right around this time is when companies will roll out deferred compensation entry for 2024, something to think about. The use of retirement plan contributions and deferrals. So really maximizing your 401k contribution and then maybe doing the catch up where it's going to benefit you because you're in a higher tax year. You'll take an IRA or 401k withdrawal in retirement when you're in a lower bracket, right? So higher bracket now, we're going to want to defer income and take withdrawals or have income paid out to us when we're in a lower bracket. We're going to keep more of our own assets from that standpoint. And then another one that is kind of flying under the radar is potentially delaying your stock option exercises. So let's say you have a lot of stock options. Typically, stock options have a 10-year duration. So you have 10 years to exercise the stock, which is the right to buy the stock at a price lower than where it's currently trading today. However, if you do that, the spread between your exercise price, which is the price that it was granted to you, and the current price, that spread is taxable income. Well, if you're working and you're in a 30-some% bracket and you exercise a stock option, that spread is going to be taxed at 30-some%, maybe even push you into a higher tax bracket. Let's say you retire and your income might be Social Security, or it might just be interest and dividends and withdrawals from your portfolio. If you exercise a stock option, that spread is taxable income, but if you're in a 12% tax bracket, that's big tax savings. The risk is, what's the stock price going to do between now and when you retire? And do you have exercise dates potentially in retirement? So once again, it's developing a plan for your stock options in conjunction with your specific situation and also your tax situation. So a good one to note there if it's available to you and if you have stock options. I'd say if you have stock options, you should really be creating a thorough plan on what's the plan to exercise, when, why, and be aware of those tax obligations. So but a big one here, Roth conversions, something that we do a lot of planning and we do a lot of advising on Roth conversions for clients. I think there's several reasons why Roth conversions can be part of a good, sound financial plan and a tax minimization strategy. Why we love them, so number one, it creates some tax diversification. So having a mix of IRA assets and Roth IRA assets allows you the ability to diversify your tax liability. Okay, I got IRA assets here. I know every withdrawal coming out of my IRA is going to be taxable income. If I have Roth IRA assets here, all of those withdrawals, so long as I've met the requirements and I'm over 59.5 and I've had the Roth for 5 years, all of those withdrawals are tax-free. So if you have both of those assets, you can then determine, okay, how can I utilize these maybe in conjunction and keep myself in these lower tax brackets or these lower tax environments. So having a Roth IRA gives you the ability to kind of lay off of all retirement withdrawals coming from the IRA, which is all taxable income. The other reason Roth conversions can be very important is required minimum distribution avoidance. So RMDs, commonly referred to, that increases your taxes, and it can push you into a higher tax bracket. So by converting some or even all of your IRA assets into Roth IRA, you're essentially creating the need to eliminate or at least reduce those RMDs. What we do for clients that are retired before RMDs, those are those gap years. So number one is we're going to look at the cash flow projection for each particular client and say, okay, when you are 73 or 75 and you have RMDs, are you spending that amount? Is that being utilized by you for your lifestyle? Does it push you into a higher tax environment than the previous year when you didn't have required minimum distribution? For many individuals, required minimum distributions are being utilized for cash flow purposes, and that's perfectly fine. That's the point, right? We're going to save for retirement. We retire. Now we're using that 401k. We're using that IRA, and we're living off of those assets. But for some investors that are in really strong financial situations and retirement situations, what we'll see with our future planning and projections is when they have to take minimum distributions, that creates a tax bump. Maybe they weren't taking IRA distributions at all or even to a minimal degree prior to being forced to. And if that's the case, then converting some of your assets from IRA to Roth prior to the RMD period is a form of tax minimization for every year that you have an RMD and beyond. What we're trying to do is smooth out your lifetime tax, not just be in a period where we have low taxes and we don't have to take money out of the IRA because we don't need to. That's a good problem to have. But then maybe there's a $100,000 required minimum distribution that you're going to take year after year after year, pushing you into a higher tax bracket. So it involves doing some projections and putting yourself in that situation for minimum distribution age and beyond, and then looking at, well, where am I currently? And maybe it's just a $20,000 conversion that makes sense. Maybe it's as much as a $60,000 conversion that makes sense. But there's a lot of reasons to do this type of planning if you're fortunate enough to be in a very strong financial and retirement situation. And then lastly, I can't say it enough, Roth IRA assets give you tax-free growth. So they're going to grow tax-free, and it eliminates future taxes on any withdrawals from those Roth assets. Also, if you're very legacy-focused and you care about the transition of your wealth to your children, let's say maybe your children are very successful and they're going to be in high tax brackets. After the Secure Act, every retirement account has to be fully distributed inside of a 10-year period of time. If you are inheriting Roth IRA assets, all of those withdrawals to you as the beneficiary are going to be tax-free. All of the withdrawals out of an inherited IRA is fully taxable income. So that's also important to think about from a legacy standpoint. Again, if you're in a strong financial situation, the likelihood is you're going to create an inheritance for your loved ones. What does that inheritance look like? Doing some of that planning now makes a lot of sense. And then we're going to round out today before I take a look at the Q&A box with what I think is the most underutilized tax minimization strategy for seniors. Unfortunately, the key word here is seniors. Qualified charitable distributions, or QCDs. You have to be 70 and a half in order to utilize this feature. But it can be very, very beneficial to your tax situation. So what is a qualified charitable distribution? It allows individuals who are 70 years old or older to donate up to $100,000. And just last week, notice came out from the IRS that this is going to be increased to 105. So 2024, it's 105. 2023, it's 100,000. You can donate up to $100,000 in 2023 to one or more charities directly from your IRA instead of taking taxable required minimum distributions. So you have a required minimum distribution. Let's say it is $70,000 and you're very charitably inclined. Let's say you're typically giving $30,000 a year to charity, so you are used to potentially itemizing. Well, now, instead of taking $70,000 out of your IRA for the minimum distribution, paying taxes on that money, and then contributing to charity, you bypass that. You take the money directly from your IRA to charity, zero taxes, and now, if it's $30,000 in a qualified charitable distribution and you had a $70,000 minimum distribution, you're only left with a $40,000 RMD. So qualified charitable distributions take the place of required minimum distributions, dollar for dollar. So arguably, if you're making any contributions to charity and you're over 70 and a half and you have an IRA, then you should be utilizing a qualified charitable distribution. So think for a second. How am I making my charitable contributions? How are my parents, my family members, my friends who are over 70 and a half and have IRAs giving to charity? Again, this is what I found to be the most underutilized tax minimization strategy. It is beautiful. Think about it. We talked about in the beginning of this webinar that 90% of tax filers are taking the standard deduction. So you get the standard deduction for $27,700. If you were giving to charity and it wasn't substantial, you weren't even utilizing that deduction because you're taking the standard. So $5,000 to your church, $10,000 to your church, doesn't matter. It's really not giving you any benefit because the standard deduction is significantly higher. Qualified charitable distribution allows you to move money from a pre-tax account that you would normally have to pay income tax on that withdrawal. It goes direct to the charity. There's no tax to you. Charity gets their funds. You're then still taking the full standard deduction. So it is an amazing feature. Again, for seniors, got to be 70 and a half, need to have an IRA, but arguably that's where your large charitable contributions and distributions should be coming from. So with that, I will take a look at our Q&A section here before we round it out. Beautiful. Doesn't look like we have any questions. Again, you're available offline to shoot us an email, set up a personal discussion now before year end on any potential tax minimization strategies. Hopefully this gave you a checklist of some items to think about with your loved ones, your spouse, or with us, and plan for having a great end of the year. Happy planning, happy tax planning, and we look forward to seeing you on our year-end webinar in mid-December. Thank you, and happy Thanksgiving to all.